There's a fundamental paradox that sits at the very heart of the market, a riddle that confuses millions of investors and drives countless entrepreneurs into the ground. It's the reason why hard work, brilliant management, and a great product often lead to financial ruin, while other, sometimes simpler companies seem to effortlessly mint fortunes year after year. The common belief is that business is a battle of execution. The company that works the hardest, innovates the fastest, and serves its customers the best will win. But this is a dangerous half-truth. It's a costly misunderstanding of the landscape. Warren Buffett, over a lifetime of study, cracked the code to this paradox. He realized that the single most important factor in a company's long-term success isn't its management, its product, or its work ethic. It's the structure of the industry in which it operates. He discovered that there are two fundamentally different types of enterprises in the world. First, there are businesses. These are the vast majority of companies. They operate in ferocious competitive arenas. They fight tooth and nail for every customer, every dollar of market share. Their life is a constant struggle against rivals, a relentless battle where victory is fleeting and profits are thin. They can be run by geniuses, but the unforgiving nature of their industry acts like a gravitational pull, constantly dragging their returns back down to mediocrity. Then, there is something else entirely, a rare and precious species of company that Buffett calls a franchise. These are businesses that operate in a protected space, shielded from the brutal winds of competition. They possess a unique characteristic, a deep and durable competitive advantage that allows them to earn high and consistent profits year after year, decade after decade. They are not immune to the laws of economics, but they have built a fortress around their profitability, an economic moat that competitors simply cannot cross. The costly mistake that 99% of investors make is failing to see this distinction. They pour their hard-earned capital into well-run businesses, trapped in terrible industries, wondering why their portfolio growth stagnates. They mistake a company's temporary success for a permanent advantage. The financial transformation that awaits you is the ability to see the market through Buffett's eyes. To learn how to sift through the thousands of public companies and identify the rare economic franchises. It is the skill of focusing your capital not on the companies that work the hardest, but on the companies that are built to win before the game even starts. This isn't just another stock-picking tip. It is a fundamental shift in your entire approach to investing, a core principle of wealth management that can lead you toward true financial freedom. This is the secret to finding the untouchable companies. Our journey into this profound concept begins not in a bustling Wall Street boardroom but in a quaint chocolate shop. The year is 1972, and Warren Buffett and his partner Charlie Munger are contemplating the purchase of a company called See's Candies. On the surface, it seemed like a peculiar investment for two men who had built their reputation on buying statistically cheap, often troubled companies. See's was anything but. It was a beloved, family-owned business, primarily operating in California, with a reputation for quality and a fiercely loyal customer base. The asking price was $30 million, a figure that the sellers, the See family, considered non-negotiable. Buffett and Munger initially valued the company at a lower figure based on its tangible assets, the factories, the stores, the inventory. The company had only $8 million in tangible book value. The asking price included a $22 million premium for something intangible, something the accountants called goodwill. For value investors trained in the school of Benjamin Graham, paying such a massive premium for an invisible asset was borderline heretical. Graham had taught them to buy businesses for less than their liquidation value, to focus on the numbers on the balance sheet. This deal violated that core tenet. Their initial offer was turned down flat. Munger, in particular, was adamant. They shouldn't overpay, they should stick to their discipline. For a moment, it seemed the deal was dead. But a third partner in their circle, a man named Ira Marshall, urged them to reconsider. He told them, bluntly, that they were being fools. He insisted they were missing the true value of the business and that they should just pay the $30 million. After some soul-searching, they relented. Berkshire Hathaway acquired See's Candies for $25 million, a slight reduction from the initial ask, but still a price that made them deeply uncomfortable at the time. What they soon discovered would permanently alter their investment philosophy and become the bedrock of the Berkshire Hathaway empire. See's Candies was not just a business, it was a franchise in its purest form. It was a cash-generating marvel. In that first year, See's earned about $2 million after tax. That might not sound extraordinary, but the magic was in how it achieved those earnings. The business required only $8 million of tangible assets to operate. This meant it was generating a 25% after-tax return on the capital actually invested in the business. This was a stunning figure. Most businesses, like steel mills or auto manufacturers, had to invest enormous sums of money in new plants and equipment just to stay competitive, let alone grow. See's was different. It grew, but its capital needs were minuscule. The brand itself was the primary asset, and that brand lived in the minds of millions of Californians. People didn't just buy See's chocolate, they bought a piece of their childhood, a gift for Valentine's Day, a comforting tradition. A customer who had been given a box of See's by a suitor in 1950 was now buying it for her grandchildren in 1972. The emotional connection was profound. This loyalty gave See's something extraordinary: pricing power. Each year after Christmas, Buffett would instruct the CEO, Chuck Huggins, to raise the prices. And every year, customers would grumble for a moment and then pay the higher price. The sales volume barely budged. They discovered they could increase prices by 10% a year, and all of that increase would fall straight to the bottom line as pure profit, with no additional capital investment required. This was the revelation. See's Candies was a gusher of cash. The profits it generated didn't need to be plowed back into the chocolate business. They could be taken out and deployed elsewhere, to buy other wonderful businesses. Over the next few decades, See's would generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all from that initial $25 million investment and with very little additional capital required. It was the gift that kept on giving. It taught Buffett and Munger the most important lesson of their careers. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. They had stumbled upon the power of an economic franchise, and it would change their approach to capital allocation forever, forming a key pillar of their entire wealth management strategy. The magic of See's Candies wasn't rooted in a complex manufacturing process or a revolutionary technology. It was rooted deep in the human psyche. The underlying psychological principle that made See's such a powerful franchise is known as the affect heuristic. This is a mental shortcut that allows people to make decisions and solve problems quickly and efficiently, in which current emotion, fear, pleasure, surprise, influences decisions. In simple terms, it means that our feelings about something often override our rational analysis of it. When a customer walked into a See's candy shop, they weren't just engaging in a simple transaction to acquire confectionery. They were stepping into a pool of positive emotions, a reservoir of happy memories and cultural associations. The black and white checkered floor, the pristine white uniforms of the employees, the free samples, it was all part of a carefully cultivated experience that triggered feelings of nostalgia, comfort, quality, and generosity. The decision to buy See's for Valentine's Day or as a hostess gift wasn't a calculated choice based on a cost-benefit analysis of cocoa content versus price. It was an emotional decision. The buyer was purchasing the feeling of giving a trusted, high-quality gift. They were buying the certainty of a positive reaction from the recipient. This emotional payload created an incredibly powerful brand association. The brand See's Candies became a shorthand for "I care." Attempting to compete with this was nearly impossible for a rival. A new chocolate company could potentially make a product that tasted just as good, or even slightly better, in a blind taste test. They could even offer it at a lower price. But they could not replicate the decades of accumulated emotional goodwill stored in the collective consciousness of their customers. A young man trying to impress a date's mother wouldn't risk bringing a box of Brand X chocolates, even if they were cheaper. The risk of appearing cheap or thoughtless was too high. He would buy the C's because the brand itself communicated the right message. This is the power of the affect heuristic in action. The positive feelings associated with the brand create an irrational loyalty that transcends the product's physical attributes. It makes the purchasing decision automatic and shields the company from price competition. Buffett learned from C's that the most valuable asset a company can have is a piece of real estate in the consumer's mind. When a brand is lodged in that mental space and linked to powerful positive emotions, it acts as an impenetrable barrier to entry, a core characteristic of a true economic franchise. This understanding shifted his stock analysis from just looking at numbers on a page to investigating the psychological relationship between a company and its customers, a much deeper and more predictive form of industry analysis. So how can we, as retail investors or entrepreneurs, translate this powerful insight into a practical tool for our own decision-making? We can develop a mental model, a blueprint, that helps us identify businesses with this same franchise-like quality. Let's call it the toll booth test. The core idea is that a great franchise operates like a toll booth on a critical bridge. If people need to cross that bridge, they have no choice but to pay the toll. The owner of the bridge can raise the toll every year, and people will complain, but they will continue to pay because the alternative, swimming across the river or driving 100 miles out of the way, is far worse. To apply this test, you need to follow a three-step process. First, you must identify the toll. Does the company sell a product or service that customers feel they must have, either due to habit, emotion, or a lack of viable alternatives? For C's Candies, the toll was emotional. For millions of people on the West Coast, giving a gift of C's on a special occasion was a non-negotiable social convention. For a company like Moody's, the credit rating agency, the toll is regulatory and procedural. If a corporation wants to issue debt, its must get a rating. The brand itself is the toll gate. Ask yourself, is this a want-to-have product or a have-to-have product in the mind of the consumer? The second step is to test for pricing power. This is the most critical element. A true toll booth can raise its prices without suffering a significant loss of business. Imagine the company you're analyzing raises its prices by 10% tomorrow. What would happen? Would its customers flee to a competitor in droves? Or would they, like the C's customers, grumble for a bit and then pay up? You can investigate this historically. Go back and read the company's annual reports from 10 or 15 years ago. Look for mentions of price increases. Did management talk about them? How did sales volume react in the following year? If a company has consistently raised prices faster than inflation without losing market share, you are likely looking at a very powerful franchise. A business with no pricing power is at the mercy of its industry. A business with pricing power controls its own destiny. The third and final step is to calculate the capital-light nature of the business. A toll booth is a beautiful business because once it's built, it requires very little additional capital to maintain. It just sits there and collects money. A great franchise is the same. It can grow its earnings power without having to constantly reinvest huge sums of money. You can get a rough measure of this by looking at what Buffett calls the owner earnings, or by doing a simplified calculation. Look at the change in the company's earnings over the last 5 years and compare it to the change in its net tangible assets, total assets minus goodwill and minus all liabilities. A franchise like C's will show a large increase in earnings with a very small increase in the tangible assets required to produce those earnings. A capital-intensive business, like an airline, will show that even small increases in earnings required massive investments in new planes. This blueprint, identifying the toll, testing for pricing power, and confirming its capital-light nature, is a powerful filter. It allows you to move beyond surface-level analysis and identify the truly exceptional companies, the ones that can compound your capital for decades, forming the bedrock of a portfolio designed for long-term growth and beating the S&P 500. To truly appreciate the genius of focusing on franchises, we must dedicate time to understanding the alternative, the path that 99% of companies, entrepreneurs, and investors find themselves on. This is the path of the commodity trap. A commodity business is one that sells a product or service that is virtually indistinguishable from its competitors. The only thing that matters to the customer is price. Think of a wheat farmer, a copper miner, a gasoline station, or a basic textile mill. The wheat from farmer A is identical to the wheat from farmer B. The copper from one mine is the same as copper from another. The defining characteristic of these industries is a complete and utter lack of pricing power. The price is set by the brutal, impersonal forces of supply and demand. If there's a bumper crop of wheat, the price collapses for everyone, regardless of how hard any individual farmer worked. This is the world that most businesses inhabit, even if they don't realize it. An airline seat is a classic example. For most travelers on a specific route, the primary decision factor is the price of the ticket. Is American Airlines' seat from New York to Chicago fundamentally different from United's? Not really. As a result, the airlines are locked in a perpetual and bloody price war. One airline announces a sale, and the others must immediately match it or risk flying empty planes. This constant competitive pressure is murder on profitability. It also creates a horrific capital cycle. To stay competitive, an airline must constantly spend billions of dollars on new, more efficient aircraft. But these investments rarely lead to higher profits. They are simply the price of admission to stay in the game. The money is spent, but the customer, not the shareholder, reaps the benefit in the form of lower fares. Warren Buffett famously quipped that if a capitalist had been present at Kitty Hawk, he should have shot Orville Wright down. He has described the airline industry as a death trap for investors. Even with brilliant management, the fundamental economics of the industry are so poor that it is nearly impossible to generate consistent, high returns on invested capital. This is the commodity trap. The 99% path is to get lured into these industries. An entrepreneur sees an opportunity to start a new trucking company or a new restaurant. An investor sees an airline stock that looks cheap after a market downturn. They might be right about the quality of the management or the short-term prospects. But they are missing the bigger picture. They are placing a bet on a horse stuck in mud. The harder it struggles, the deeper it sinks. Ignoring the distinction between a franchise and a commodity business is one of the most common and destructive mistakes in both investing and business strategy. It leads to a tremendous amount of wasted effort, squandered capital, and ultimately the failure to achieve any meaningful form of financial freedom. The path of the 99% is paved with well-run companies in terrible industries. The difference between a franchise and a business isn't just a theoretical concept. It manifests directly and powerfully on a company's financial statements. The direct financial connection can be seen most clearly through a metric that Buffett came to prize above almost all others: return on tangible capital employed, or ROTCE. Let's break this down. Tangible capital employed is the actual physical capital needed to run the business, the factories, the equipment, the inventory. It's the real money that's tied up in the operations. The return is the after-tax profit the business generates. The ratio tells you how much profit the company makes for every dollar of real capital it has invested. A franchise, by its very nature, will have a spectacularly high ROTCE. Let's return to our See's Candies example. In 1972, it was earning $2 million a year using only $8 million of tangible capital. That's a 25% return. Now let's contrast that with a hypothetical steel mill from the same era. To earn $2 million in profit, that steel mill might require $100 million worth of blast furnaces, rolling mills, and raw material inventory. Its ROTCE would be a meager 2%. This is the stark, quantifiable difference. The franchise generates enormous profits from a tiny capital base, while the commodity business generates tiny profits from an enormous capital base. This has a profound impact on the creation of wealth. The steel mill is a capital sinkhole. Any profit it makes has to be immediately reinvested into maintaining its old, expensive equipment, or buying new equipment just to keep up with competitors. There is very little cash left over for the owners. The franchise, on the other hand, is a capital gusher. The $2 million in profit from See's was free and clear. It didn't need to be reinvested into the candy business. That cash could be extracted by its owners, in this case, Berkshire Hathaway, and used to buy other assets, like more stocks or another whole company. The franchise becomes an engine for compounding wealth across an entire portfolio. The steel mill consumes wealth just to survive. This is the financial magic that Buffett discovered. He stopped looking for companies that were cheap based on their assets and started looking for companies that could generate high returns on their assets. A balance sheet of a franchise often looks deceptively small. Its greatest asset, the brand, the customer loyalty, isn't even listed under GAAP accounting rules. The balance sheet of a commodity business is often huge and bloated with physical assets that earn pathetic returns. By learning to read the financials through this lens, you can spot the difference. You can see which companies are creating true economic value and which are simply running on a capital-intensive treadmill. This ability to quantify the power of a franchise is what separates amateur stock picking from professional-grade wealth management, and it is the key to unlocking superior capital gains over the long run. The power of a franchise often lies in something you can't touch or see. It's an intangible force that creates a very real, very durable barrier against competition. This leads us to the first great pillar of power, the intangible asset moat, which is most often built on the foundation of a powerful brand or a protective patent. The ultimate case study in the power of a brand is not one of Buffett's successes, but a near-death experience for a company he would come to own a significant stake in, American Express. The story begins in 1963 in Bayonne, New Jersey. A small, unassuming company called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, was a major customer of a division of American Express that provided warehousing services. Allied would store giant vats of salad oil in the American Express warehouse, and in return, American Express would issue receipts for that oil. Other banks would then lend money to Allied, using those receipts as collateral. It was a mundane, profitable business. The problem was, Tino DeAngelis was a con man. His vats were mostly filled with water, with only a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied Crude Vegetable Oil collapsed overnight, owing banks over $175 million, a colossal sum at the time. The banks, holding worthless receipts from American Express, sued. Wall Street panicked. American Express's stock plummeted by over 50%. The consensus view was that the company was ruined. The potential liabilities from the lawsuits could wipe out its entire net worth. This was precisely the kind of situation that attracted Warren Buffett. It was a high-quality company, a leader in its field, now facing a massive, one-time, and very public problem. But Buffett didn't just look at the numbers. He did what he called scuttlebutt research. He set out to determine if the scandal had damaged the one thing that truly mattered, the company's brand in the mind of the consumer. He went to restaurants and hotels in his hometown of Omaha. He talked to the managers. He asked them if they were seeing any drop-off in the use of American Express credit cards or traveler's checks. The answer was a resounding no. People were still using the green card for business dinners. Travelers were still buying the checks for their vacations. He went to local banks and talked to the tellers, asking the same questions. Again, the answer was the same. The use of the product was completely unaffected. He even observed his competitors. He saw that a rival bank was actively trying to get merchants to switch from American Express to its own card system, with little success. What Buffett discovered was that the American Express brand was an entity entirely separate from the American Express Corporation. The scandal was a corporate problem, a financial problem. But the brand, which represented trust, prestige, and worldwide acceptance, lived unharmed in the minds of millions of customers and merchants. The value of the little green card was not tied to the company's balance sheet. It was tied to the strength of its network and the status it conferred upon its user. This intangible asset was so powerful that it could withstand a direct hit that would have sunk almost any other company. Convinced that the market was overreacting, Buffett made one of the boldest moves of his early career. He invested 40% of his investment partnership's entire capital into American Express stock. It was a massive, concentrated bet. Over the next few years, the company settled the lawsuits for a manageable sum, the scandal faded from memory, and the business continued its relentless growth. The stock soared, and Buffett's partnership made a fortune. The salad oil scandal became the ultimate proof of the power of an intangible asset moat. It demonstrated that a truly great brand is a fortress, capable of protecting a company's earning power even in the face of a catastrophic event. It is a lesson in value investing that goes far beyond simple metrics, a deep dive into the psychology of consumer behavior and its impact on long-term portfolio growth. The resilience of the American Express brand during the salad oil scandal can be explained by a potent psychological principle known as the commitment and consistency bias. This is our deep-seated psychological need to be and to appear consistent with what we have already done or said. Once we make a choice or take a stand, we will encounter personal and interpersonal pressures to behave consistently with that commitment. For decades prior to 1963, American Express had cultivated an aura of prestige and reliability. Carrying the card was a status symbol. It signaled that you were a person of means, a member of a select club. When a person made the choice to become an American Express cardholder, they weren't just choosing a payment method, they were making a statement about their identity. This was the commitment. The consistency principle then kicks in. Having made this commitment, the cardholder would subconsciously filter information to support their decision. They would focus on the brand's positive attributes, its widespread acceptance, its customer service, its prestige, and downplay or ignore negative information, like the news of a scandal in an obscure warehousing division. To abandon the card because of the scandal would be to admit that their initial judgment was flawed, that their identity statement was based on a faulty foundation. This creates a cognitive dissonance that is uncomfortable, so most people simply choose to remain consistent with their prior commitment. The brand becomes part of who they are. The same principle applied to the merchants. A fine dining restaurant that accepted American Express was signaling to its clientele that it catered to a certain caliber of customer. To stop accepting the card would be to break consistency with that image. This creates a powerful, self-reinforcing loop. Customers use the card because it's part of their identity, and merchants accept the card because it's part of theirs. A competitor, even one offering lower merchant fees, faces an enormous uphill battle. They are not just asking a customer or a merchant to switch products, they are asking them to change their identity. This is why a brand moat is so powerful. It doesn't exist on a spreadsheet. It exists in the web of psychological commitments that tie millions of users together. Understanding this principle is a crucial part of executive decision-making, both for managers looking to build a brand and for investors looking to identify one. A company that has successfully intertwined its product with its customers' sense of self has built a competitive advantage that is almost priceless, a key factor in achieving lasting financial freedom. How can an individual investor without the resources to conduct a nationwide scuttlebutt campaign systematically identify companies with this powerful intangible asset moat? The answer lies in using a practical mental model we can call the mind share audit. This is a three-part process designed to measure how much real estate a brand occupies in the collective consumer mind. The first step is the unprompted recall test. It's a simple but effective exercise. Pick a product category and ask 10 people who represent the target demographic to name the first brand that comes to their mind. For example, if you're analyzing a sportswear company, ask, when you think of athletic shoes, what's the first company you think of? If 9 out of 10 people say Nike without hesitation, you have a powerful indicator of dominant mindshare. This top-of-mind awareness is incredibly valuable. It means the company doesn't have to fight as hard for attention. It already owns it. The second step is the genericide check. This is the ultimate test of brand dominance. As the brand becomes so powerful that its name has replaced the generic term for the product itself, we ask for a Kleenex, not a facial tissue. We put a Band-Aid on a cut, not an adhesive bandage. We Google something, we don't search for it on the internet. When a brand achieves this level of linguistic saturation, it has built an almost unassailable moat. It has become the default, the standard by which all others are judged. A competitor isn't just fighting another company, it's fighting the English language itself. This is a rare phenomenon, but companies that achieve it are often among the best long-term investments. The third and final step is a quantitative measure, the pricing power analysis. A strong brand should translate directly into the ability to charge a premium price. Go to a supermarket and compare the price of a bottle of Coca-Cola to the store brand cola sitting right next to it. The price difference, often significant, is a tangible measure of the brand's value. People are willing to pay that premium for the consistency, the taste, and the emotional connection associated with the Coca-Cola brand. You can do this for almost any consumer product. Compare the price of a branded pharmaceutical to its generic equivalent after the patent expires. The fact that many people still choose to pay more for the original brand is a testament to the trust and familiarity it has built over years. By conducting this three-part mind share audit, any retail investor can perform a sophisticated stock analysis. It forces you to look beyond the numbers and evaluate the true source of a company's competitive advantage, giving you a massive edge in identifying the kind of businesses that can lead to exceptional portfolio growth. The path of the 99% is littered with the corpses of companies that investors mistook for having a durable brand. This common error can be called the brand chaser's folly. It is the act of confusing a temporary fad or a popular product with a genuine, long-lasting, intangible asset moat. The landscape of the stock market is filled with examples. Think of companies like GoPro or Fitbit. For a time, they were the darlings of Wall Street. Their products were everywhere, their sales were exploding, and their stock prices shot to the moon. Many investors, caught up in the excitement, believed they were investing in the next great consumer brand, the next Apple or Nike. But they were making a fatal mistake. They failed to distinguish between popularity and a true competitive advantage. GoPro made excellent action cameras, but was there anything truly proprietary about them? Was there a deep emotional connection that would stop a customer from buying a technically similar and cheaper camera from Sony or a dozen other competitors? The answer was no. The same was true for Fitbit. They were pioneers in the wearable fitness tracker market, but their brand didn't confer any real pricing power or create significant customer loyalty. As soon as Apple entered the market with its watch and a flood of cheaper alternatives from China appeared, Fitbit's market share and profitability collapsed. The investors who bought at the peak of the hype, believing they owned a piece of a powerful franchise, were wiped out. The brand chaser's folly stems from an inability to answer the critical question: what prevents a competitor from offering a similar product for a lower price? For GoPro and Fitbit, the answer was nothing. For a company like Coca-Cola, the answer is a century of branding, a global distribution network, and a secret formula. For a pharmaceutical company with a patent, the answer is the law. A fad creates temporary high sales. A true brand moat creates durable high profits. The 99% of investors get mesmerized by the former, chasing exciting stories and hot products. They buy high, hoping the trend will continue forever. But trends fade, and competition always arrives. The disciplined investor, the one practicing a Warren Buffett strategy, understands that the real value lies not in what's popular today, but in the structural advantages that will protect a company's profitability for decades to come. Avoiding this folly is a critical discipline for any serious approach to wealth management and a prerequisite for beating the S&P 500 over the long term. The power of an intangible asset like a brand isn't just a marketing concept, it's a financial reality that can be clearly identified and measured on a company's income statement. The most direct financial connection is seen in a company's gross margin. Let's take a moment to look at the top of the income statement. You have revenue, which is the total amount of sales. Right below that, you have the cost of goods sold, COGS, which is the direct cost of producing the product, the raw materials, the manufacturing labor. When you subtract COGS from revenue, you get gross profit. The gross margin is simply the gross profit divided by the revenue, expressed as a percentage. This number tells you how much profit a company makes on each dollar of sales before accounting for other expenses like marketing, research, and administration. A company with a powerful brand moat will almost always have sustainably high gross margins. Consider Coca-Cola again. What are they actually selling? In essence, it's sugar water and a secret syrup formula. The physical cost of producing a can of Coke is incredibly low, but because of the power of their brand, they can sell that can for a relatively high price. As a result, Coca-Cola's gross margin is consistently over 60%. For every dollar of Coke they sell, 60 cents is pure gross profit. Now compare that to a generic, store-brand soda company. They are also selling sugar water, but they have no brand power. They can only compete on price. To get shelf space at the supermarket, they have to sell their product for a much lower price, leaving them with a razor-thin gross margin, perhaps only 10% or 15%. This enormous difference in gross margin is the financial fingerprint of the brand moat. This advantage then flows all the way down the income statement. Because Coca-Cola has so much gross profit to work with, it can afford to spend billions on advertising to further strengthen its brand, pay its executives well, invest in new products, and still have a massive amount of net income left over for its shareholders. The low-margin competitor is in a constant struggle for survival. They have no money for advertising, no room for error. A small increase in the price of sugar could wipe out their entire profit for the year. As an investor doing stock analysis, comparing the gross margins of a company to its direct competitors over a 5 or 10-year period is one of the most effective ways to identify a durable competitive advantage. A consistently high and stable gross margin is a clear sign that you are looking at a powerful franchise, a business that translates its intangible strength into tangible cash flow, the true engine of value investing and long-term capital gains. We now turn to a different but equally powerful source of franchise value. This is a competitive advantage that isn't built on love or emotion, but on something far more pragmatic: pain. This is the second pillar of power, the switching cost moat. A business has a switching cost moat when its customers are locked in, not by affection for the product, but because the cost, difficulty, or risk of moving to a competitor is simply too high. One of the best historical examples of this can be found in a business that Buffett knows intimately: Moody's Corporation, the credit rating agency. To understand the power of Moody's, you first have to understand its role in the financial ecosystem. For the better part of a century, if a large corporation or a government wanted to borrow money by issuing bonds, it was practically a requirement to get a credit rating from one of the two dominant players, Moody's or Standard & Poor's. This rating, AAA, BA, C, and so on, was an independent assessment of the issuer's ability to repay its debt. The entire global bond market, a multi-trillion-dollar industry, was built upon the foundation of these ratings. Investment funds have mandates that only allow them to buy bonds above a certain ratings. Banks use the ratings for their own risk management. The system was, and still largely is, hardwired to rely on these ratings. Now, consider the position of a chief financial officer of a major corporation looking to issue $1 billion in bonds. The cost of getting a rating from Moody's might be a few $100,000. This is a tiny, almost negligible fraction of the total amount being raised. However, the consequence of not getting that rating would be catastrophic. The company would be unable to sell its bonds, or would have to pay a much higher interest rate, costing them tens of millions of dollars over the life of the bond. The choice was obvious: you had to pay the toll to Moody's. But what about switching to a new, up-and-coming rating agency that offered a lower price? This is where the switching cost becomes insurmountable. The risk is simply too great. The bond market is built on trust and reputation. A rating from New Guy Ratings Inc. is worthless because nobody trusts it. Investors would shy away from bonds rated by an unproven agency. The CFO who chose the cheaper, unknown agency to save a tiny amount of money and then found they couldn't place their bonds would be fired on the spot. It was a career-ending risk. Therefore, everyone stuck with the duopoly of Moody's and S&P. They had an unbreachable moat built on the high stakes and institutional inertia of the global financial system. The pain of switching was just too high, giving them incredible pricing power and making them one of the most profitable businesses on a per dollar of capital basis in the world. The powerful grip that companies like Moody's have on their customers is deeply rooted in human psychology. Two specific cognitive biases work in concert to create the foundation of the switching cost moat: the status quo bias and loss aversion. The status quo bias is our innate preference for the current state of affairs. All things being equal, we tend to resist change. Change requires effort, it introduces uncertainty, and it forces us to learn new things. Our brains are wired to conserve energy, so we have a natural tendency to stick with what we know, even if a slightly better alternative is available. Think about your personal bank. You've likely been with the same bank for years. Is it because it offers the absolute best interest rates and the lowest fees? Probably not. It's because the thought of switching is a massive headache. You'd have to move your direct deposit, update all your automatic bill payments, get new debit cards, and learn a new online banking interface. The perceived hassle of this process is often enough to prevent you from seeking out a better deal. You stick with the status quo. Now let's amplify this with the much more powerful bias of loss aversion. This is the well-documented psychological principle that people feel the pain of a loss approximately twice as much as they feel the pleasure of an equivalent gain. Losing $100 feels much worse than finding $100 feels good. When a customer considers switching from a trusted, known provider to a new one, they weigh the potential gains against the potential losses. The potential gain might be a slightly lower price or a few new features, but the potential losses are terrifying. What if the new payroll software company makes a mistake and your employees don't get paid? What if the new database system loses years of critical customer data? What if the new unproven rating agency's rating is not accepted by the market? The fear of these potential losses is magnified in our minds by loss aversion. The small, certain gain of a lower price is rarely enough to overcome the large, uncertain fear of a catastrophic failure. This combination of mental inertia, status quo bias, and an exaggerated fear of negative outcomes, loss aversion, is the psychological cement of the switching cost moat. Companies that benefit from this don't need their customers to love them. They just need the perceived pain of leaving to be greater than the perceived pleasure of arriving somewhere new. This is a subtle but incredibly durable form of competitive advantage, a cornerstone of a sound Warren Buffett strategy for identifying businesses that can stand the test of time. For the retail investor or the entrepreneur, identifying the strength of a switching cost moat requires a structured approach. We can create a practical mental model for this, a tool we'll call the Pain of Switching Scorecard. This scorecard breaks down the nebulous concept of pain into 4 distinct, measurable categories. For any company you analyze, you rate the pain of switching from 1 to 10 in each area. The first category is financial pain. This is the most straightforward. Are there direct, explicit costs associated with making a switch? For example, a mobile phone company might charge a hefty early termination fee to break a contract. A business using specialized software might have to pay for expensive new hardware to run a competitor's system. The higher the direct financial cost, the higher the score in this category. A score of 10 would be a situation where the cost of switching is almost as high as the value of the service itself. The second category is procedural pain. This measures the effort and time required to make the switch. How much work is involved? Migrating a decade's worth of financial data from one accounting system to another is a massive, complex project that can take months and carries significant risk. Retraining an entire sales force on a new customer relationship management software is a huge drain on productivity. Conversely, switching from one brand of coffee to another involves 0 procedural pain. A high score here indicates that the company's product is deeply embedded in the customer's daily workflow. The third category is relational pain. This deals with the human element. Will switching providers damage important personal or business relationships? Consider a small business owner who has banked with the same local community bank for 20 years. The bank manager knows their family, has helped them through tough times, and provides personalized advice. Switching to a large, impersonal national bank to save a fraction of a percent on a loan might sever a valuable, long-standing relationship. This pain, while not financial, can be a powerful deterrent to change. Finally, the fourth category is risk pain. This is often the most important. What is the probability and potential impact of the new provider failing or being significantly inferior? For a mission-critical service like the software that runs a hospital's patient records or the rating agency for a multi-billion-dollar bond, the risk of failure is unacceptable. The cost of the service is trivial compared to the cost of a mistake. Companies that provide these can't-fail services have the highest possible score in this category. By systematically scoring a company across these four categories, you can generate a tangible measure of its switching cost moat. A company with high scores across the board is a fortress. This is a level of deep industry analysis that goes far beyond looking at a price-to-earnings ratio and helps you identify the kind of resilient, predictable businesses that are essential for long-term portfolio growth. The antithesis to the high switching cost fortress is what we can call the price shopper's paradise. This is an industry where the cost of switching is zero or even negative, meaning you might get a promotional bonus for switching. In these environments, there is no customer loyalty. The relationship between the company and the customer is purely transactional, and the only basis for competition is price. Think about choosing a gas station. You might have one you use out of habit, but if the station across the street is 5 cents a gallon cheaper, you'll likely switch without a second thought. There is no financial, procedural, relational, or risk-based pain in doing so. Your car won't run any differently. This is the brutal reality for companies that operate in these low-friction environments. They are in a constant, desperate scramble to attract and retain customers who feel no allegiance to them. This category includes many retail businesses, especially those selling non-differentiated products. It includes most commodity producers and many consumer services where price comparison is easy. The rise of the internet has turned many formerly sticky industries into price shoppers' paradises. It used to be a hassle to compare insurance quotes or book a flight. Now, aggregator websites can show you a dozen options in seconds, commoditizing the entire industry and forcing providers to compete almost solely on price. For entrepreneurs, entering a price shopper's paradise is a high-risk gamble. Your business has no defense. Any success you have will immediately attract competitors who will undercut your price, vaporizing your margins. It becomes a race to the bottom where the winner is often the company that can survive losing money the longest. For investors, these industries are dangerous ground. A company might have a good quarter or even a good year, perhaps due to a temporary price advantage or a clever marketing campaign. But the long-term economics are almost always poor. Without the anchor of switching costs, their profitability is volatile and unpredictable. The 99% of investors are often lured in by what looks like a cheap stock, failing to recognize that the business itself has no durable competitive advantage. Mastering the discipline of identifying and avoiding these industries is just as important as finding the ones with strong moats. It is a fundamental principle of capital preservation and a critical skill for anyone serious about wealth management and achieving financial freedom. The financial evidence of a switching cost moat is clear and quantifiable, found in two key metrics that are scrutinized by savvy investors in private equity firms: the customer churn rate and the customer lifetime value (LTV). The churn rate is the percentage of customers who stop using a company's service over a given period. A company operating in a price shopper's paradise might have an incredibly high churn rate, 30%, 40%, or even 50% per year. They are constantly losing customers and have to spend enormous amounts on sales and marketing just to replace them, a concept known as the leaky bucket. A business protected by a high switching cost moat will have a very low, almost negligible churn rate. Think of a company that provides the core accounting software for a large corporation. Their churn rate might be less than 2% per year. Once a customer is in, they almost never leave. This low churn rate leads directly to highly predictable, recurring revenue streams, which are immensely valuable. Predictability is a holy grail for investors because it reduces risk and allows for more accurate long-term financial planning. This brings us to the second metric, customer lifetime value, or LTV. A simple way to calculate LTV is to take the average annual revenue per customer and divide it by the annual churn rate. Let's look at two hypothetical software companies. Company A has a high churn rate of 50%, and its average customer pays $1,000 a year. Its LTV is $1,000 divided by 0.50, which equals $2,000. Company B is protected by high switching costs and has a low churn rate of 5%. Its average customer also pays $1,000 a year. Its LTV is $1,000 divided by 0.05, which equals $20,000. Even though both companies generate the same revenue per customer today, the customer of Company B is 10 times more valuable over the long run. This is a staggering difference. A small decrease in churn leads to a massive increase in long-term value. Companies with high LTV can afford to spend more to acquire a new customer, and each customer they acquire adds significantly more value to the enterprise. When you are doing your stock analysis, look for companies that disclose their churn rates, often found in presentations to investors or annual reports for subscription-based businesses. A consistently low churn rate is the financial smoking gun of a powerful switching cost moat. It is a direct signal that the company has a captive audience, a predictable future, and a business model built for durable, long-term portfolio growth. The third great pillar of power is a phenomenon that seems to defy business logic, a business that actually gets better and stronger as it gets bigger. This is the network effect moat. A company has a network effect when the value of its product or service increases for each user as more users join the network. It's a virtuous cycle, a feedback loop that can create a position of incredible winner-take-all dominance. A classic pre-internet example that Buffett understood intimately was the economics of a dominant local newspaper, like his storied investment in the Washington Post. In the 1970s, a city like Washington, D.C. could really only support one major, profitable newspaper. The reason was a two-sided network effect. On one side you had the readers, on the other you had the advertisers. The two sides reinforced each other. As more readers chose to subscribe to the Washington Post, it became more valuable for advertisers. Department stores, car dealerships, and grocery stores had to place their ads in the Post because that's where all the eyeballs were. As more advertisers flocked to the Post, it became more valuable for readers. It was the one-stop shop to find movie times, classified ads for jobs and apartments, and sales at local stores. The paper with the most readers got the most ads, and the paper with the most ads got the most readers. It was a powerful, virtuous cycle. A potential competitor, like the now-defunct Washington Star, was trapped in a vicious cycle. Because it had fewer readers, it attracted fewer advertisers. And because it had fewer advertisers, it was less useful to readers, causing even more of them to leave. The Post's dominant position became a self-fulfilling prophecy. Its product literally got better as its market share grew. Buffett saw that this structural advantage was almost impossible for a competitor to overcome. It wasn't about having better journalists or a better printing press. It was about the power of the network. The Washington Post didn't have to be the best-managed paper in the country to be the most profitable. Its economic moat, built on the local network effect, guaranteed its success. This understanding that some businesses have a built-in momentum that makes the rich get richer is a key insight for identifying franchise businesses that can dominate their markets for decades. The powerful pull of a network effect is not just a matter of business dynamics, it's a direct exploitation of our deepest social instincts. The underlying psychological principles at play are social proof and the fear of missing out, or FOMO. Social proof is a cognitive bias where people assume the actions of others in an attempt to reflect correct behavior for a given situation. It's the wisdom of the crowd heuristic. When we are uncertain about what to do, we look to others for cues. If we see a restaurant with a long line outside, we assume the food must be good. If a product has thousands of positive online reviews, we assume it must be high quality. Network effect businesses tap into this principle on a massive scale. When you are considering which credit card to get, the fact that Visa is accepted at virtually every merchant on Earth is a powerful form of social proof. Millions of merchants and billions of cardholders can't be wrong. This perception becomes a reality. The network's ubiquity is the proof of its own value. A new payment network, even with superior technology, faces an enormous hurdle because it lacks this social proof. No one wants to be the first to adopt it. Closely related to this is the fear of missing out. FOMO is the apprehension that one might miss out on a rewarding experience that others are having. It's a powerful motivator, especially in the social realm. Social media platforms are the ultimate example of this. Why did you join Facebook or Instagram? Likely because all your friends were already there. To not be on the platform was to risk being excluded from conversations, events, and the sharing of photos and life updates. The value of the network was the presence of your own social circle. Each new person who joins a network increases the pressure on the remaining outsiders to join as well, lest they be left behind. This creates a tipping point dynamic. A network can struggle for a long time to gain traction, but once it reaches a critical mass of users, its growth can become explosive and seemingly unstoppable. The psychological pressure to conform and connect becomes the company's most powerful marketing tool. As an investor, identifying a business that is approaching or has passed this tipping point is like finding a company with a built-in, self-perpetuating growth engine. It's a crucial part of any stock analysis aimed at beating the S&P 500. To harness this concept for our own investment decisions, we need a mental model to visualize and assess the strength of a network effect. Let's call it the virtuous cycle map. This is a simple but powerful tool for breaking down a network business into its core components. The first step is to identify the nodes. Who are the distinct user groups that make up the network? A network can be one-sided, like a telephone network where the users, callers, are all the same. But many of the most powerful network businesses are two-sided or multi-sided. For Visa, the nodes are cardholders on one side and merchants on the other. For a platform like Uber, the nodes are riders and drivers. For the Washington Post, it was readers and advertisers. Clearly defining these user groups is the essential first step. The second step is to map the value exchange. Now, you draw arrows between the nodes to show how growth in one group adds value to the other groups. For Visa, you draw an arrow from cardholders to merchants labeled more potential customers. Then you draw an arrow back from merchants to cardholders labeled more places to use the card. This creates a closed loop, the virtuous cycle. The stronger and more direct these value-creating arrows are, the more powerful the network effect. A business where the cycle is weak or indirect is less likely to have a durable moat. The third and final step is to assess the tipping point. This is a more qualitative judgment. Has the network reached a point of critical mass where it has become the default standard in its industry? Is it now irrational for a new user not time to join? For Visa, that point was passed decades ago. A merchant who doesn't accept Visa is actively turning away business. For a new social media app, it might still be in the pre-tipping point phase, fighting to attract its first critical mass of users. Investing before the tipping point is a high-risk, high-reward venture capital-style bet. Investing after the tipping point, as Buffett often does, is a much safer way to buy into a dominant, established franchise. By using the virtuous cycle map, a retail investor can deconstruct the magic of a network effect business. It helps you understand the mechanics of its growth and assess the durability of its competitive advantage, providing a structured way to think about one of the most powerful forces in business and a key driver of long-term capital gains. For every successful network business that reaches a tipping point, there are thousands that fail. The path of the 99% is defined by what we can call the empty room problem. This is the fundamental chicken and egg challenge that faces any aspiring network business. An online marketplace is worthless without sellers, but no sellers will join until there are buyers. A social media app is useless without users, but no users will join until their friends are there. A new payment system is pointless without merchants, but no merchants will adopt it until customers have it. The new network starts as an empty room, an empty nightclub. Why would anyone want to be the first person on the dance floor? This is the cold start problem, and it is incredibly difficult and expensive to solve. Most entrepreneurs and investors dramatically underestimate the amount of capital, marketing savvy, and sheer luck required to overcome it. They might have a better technology or a slicker interface, but that's not enough. They need to solve the social coordination problem of getting a critical mass of users to all show up at the same time. Many failed companies litter this path. Countless challengers to eBay, Facebook, and Visa have burned through billions of dollars in venture capital, only to crash against the wall of the incumbent's network effect. They can't offer enough value to the first users to get the virtuous cycle started. They remain an empty room, and eventually, the investors turn out the lights. The 99% of investors often get drawn into these stories. They see a small company with a promising technology and a plan to disrupt a large, dominant network. They make a bet on the challenger, not realizing they are betting against one of the most powerful forces in economics. While occasionally a new network does displace an old one, it is a rare and brutal event. A far more reliable path to portfolio growth is to invest in the established, dominant network, the company that owns the crowded room, rather than the speculative startup with the empty one. Recognizing the immense difficulty of the empty room problem is a crucial discipline for any serious investor and a key part of avoiding the catastrophic losses that come from betting against a powerful, entrenched network. The financial signature of a powerful network effect moat is found in the relationship between growth and the costs required to achieve that growth, specifically the customer acquisition cost, CAC, and the degree of organic growth. In the early days of a network business, before it reaches the tipping point, the customer acquisition cost is often very high. The company has to spend heavily on marketing, subsidies, and promotions to solve the empty room problem. Uber, in its early years, famously spent fortunes on bonuses for new drivers and free rides for new passengers to kickstart its two-sided network. During this phase, the company can lose a lot of money. However, once the network effect takes hold and the virtuous cycle starts spinning on its own, something magical happens to the financials. Growth starts to become organic. New users join not because they saw an ad, but because they have to. A new restaurant asks Porcus to accept Visa. A young person entering the workforce asks Porcus to have a LinkedIn profile. A new smartphone user times to download WhatsApp to communicate with their friends. This organic growth is incredibly valuable because it is essentially free. The company's customer base expands without a corresponding increase in marketing spend. You can see this clearly on the income statement. A mature, dominant network business will often show strong revenue growth while its sales and marketing expenses, as a percentage of revenue, are low and stable, or even declining. This is a sign of immense financial health. It demonstrates that the network itself has become the primary driver of growth, not expensive advertising campaigns. This creates incredible operating leverage. As revenues grow from the organic pull of the network, the costs stay relatively flat, causing profit margins to expand dramatically. This is what Buffett means when he talks about a business that, quote, gushes cash. A business that has to constantly spend a fortune to acquire each new customer is on a treadmill. A business with a dominant network effect is on a moving walkway that is accelerating. By analyzing the trends in a company's marketing spend relative to its user and revenue growth, an investor can diagnose the strength of its network effect. A decreasing reliance on paid acquisition is a powerful signal that you have found a true franchise, a business with a self-perpetuating growth model that is a powerful engine for long-term wealth management and financial freedom. Our final pillar of power is arguably the most primal and easily understood competitive advantage, the cost advantage moat. This is a franchise built not on a fancy brand or a complex network, but on the simple, brutal ability to provide a product or service at a consistently lower cost than any competitor. When this cost advantage is structural and durable, it can be just as formidable a moat as any other. The quintessential example of this, and one of Buffett's greatest investments, is Geico. Buffett's fascination with Geico began when he was just a student at Columbia University in 1951. He was studying under Benjamin Graham, but his real education came from his own obsessive research. He discovered that Geico's stock was a favorite of Graham's, so on a Saturday, the young Buffett took a train from New York to Washington, D.C. to visit the company's headquarters. He found the building closed, but a persistent Buffett banged on the door until a janitor let him in. The janitor led him to the one executive working that weekend, Lorimer Davy Davidson, who would later become CEO. For the next 4 hours, Davidson patiently explained the entire insurance business and Geico's unique model to the eager student. Buffett emerged from that meeting with a revelation. Geico had a massive structural cost advantage that its competitors could never replicate. At the time, most insurance companies, like State Farm or Allstate, sold their policies through a vast network of independent agents who were paid a commission, typically around 15% of the premium. This was a huge, embedded cost. Geico, on the other hand, had a completely different business model. It was founded to sell directly to a select group of low-risk customers, initially U.S. government and military employees. It had no agents. It sold directly to consumers via mail and, later, by phone and internet. This direct-to-consumer model completely cut out the agent's commission, allowing Geico to offer the same insurance policy for 15% to 20% less than its competitors. This was not a temporary sale or a promotional gimmick. It was a permanent advantage baked into the very structure of the business. The low-cost provider in any industry has a tremendous advantage. For a product like auto insurance, which is essentially a commodity that is mandated by law, price is a major factor for consumers. Geico's ability to consistently offer the lowest price allowed it to relentlessly take market share, year after year, decade after decade. It was a simple, brilliant business model that created a virtuous cycle of its own. Low prices attracted more customers, and more customers created greater economies of scale, allowing for even lower costs. It was an economic fortress, and Buffett's early insight into the power of its cost advantage moat would eventually lead Berkshire Hathaway to acquire the entire company, turning it into one of the cornerstones of his empire. The incredible success of low-cost leaders like Geico or Costco is powered by two fundamental psychological principles: the pain of paying and the anchoring effect. The pain of paying is a well-documented phenomenon in behavioral economics. Parting with our hard-earned money is psychologically painful. Our brains process the act of spending money in a way that is similar to experiencing physical pain. A business that can offer a product or service at a significantly lower price is, in effect, acting as a painkiller. It directly reduces the psychological discomfort of the transaction. For a necessary but unexciting purchase like car insurance, minimizing this pain is a powerful motivator for consumers. Geico's promise of 15 minutes could save you 15% or more on car insurance speaks directly to this desire to reduce the pain of paying. It creates a simple, compelling value proposition that is hard for a higher-priced competitor to overcome. The second principle at work is the anchoring effect. This is a cognitive bias where we tend to rely too heavily on the first piece of information offered, the anchor, when making decisions. Once an anchor is set, other judgments are made by adjusting away from that anchor, and there is a bias toward interpreting other information around the anchor. Low-cost leaders are masters of setting the anchor. Costco, for example, has anchored the price of a hot dog and soda in the minds of its customers at $1.50 for decades. This incredibly low price acts as a powerful signal of the company's overall value proposition. When a customer sees that, It creates an anchor of low prices in their mind. They then assume that other items in the store, from electronics to groceries, must also be a great deal. It colors their perception of everything else. A competitor is then forced to justify why their prices are so much higher than the anchor price the customer holds in their head. It puts the high-cost business on the defensive. Geico did the same in insurance. Their constant advertising about lower prices established them as the price anchor in the industry. Other insurers were then implicitly positioned as the more expensive option. This combination is devastatingly effective. The company uses the pain of paying to attract customers with a low price, and then uses the anchoring effect to frame the entire market conversation around their value, making it psychologically difficult for consumers to choose a more expensive rival. This psychological one-two punch is a key reason why a durable cost advantage is such a powerful and sustainable economic moat. How can we as investors systematically determine if a company's cost advantage is real, durable, and structural? We need an analytical framework, a mental model we can call the structural cost audit. This is a three-step process to dig beneath the surface and find the true source of a company's low prices. The first step is to identify the source of the advantage. A cost advantage must come from somewhere. Is it based on a superior process, massive scale, a unique location, or a proprietary asset? Be specific. For Geico, the source was a process advantage, its direct-to-consumer business model. For Costco or Walmart, the source is scale. Their enormous purchasing volume allows them to demand lower prices from suppliers than any smaller competitor could hope for. For a mining company, the source might be a location advantage, owning a mine with a uniquely rich and easily accessible deposit of ore. A temporary cost advantage, like a short-term sale, is not a moat. A structural advantage is one that is built into the business model and cannot be easily replicated. The second step is to test for durability. This is the crucial question. Can a competitor copy this advantage? A rival insurance company could, in theory, try to build its own direct-to-consumer business, but it would have to fire its entire existing army of agents, which would be a massively disruptive and politically impossible move. A competitor to Costco would need to build a global supply chain and achieve similar sales volumes to get the same prices from suppliers, a task that would take decades and hundreds of billions of dollars. The more difficult, expensive, and time-consuming it would be for a competitor to replicate the cost advantage, the more durable the moat. The third and final step is to measure the margin gap. The proof of a durable cost advantage should be visible in the financial statements. A true low-cost leader should be able to consistently earn higher operating margins than its competitors, even while charging lower prices to the end consumer. This might seem paradoxical, but it's the hallmark of a great business. Geico has a lower cost structure, so even with lower premiums, a larger percentage of that premium falls to the bottom line as profit compared to its agent-based rivals. You can perform this analysis yourself. Take the company you are studying and chart its operating margin over the last 10 years. Then do the same for its three largest competitors. A company with a durable cost advantage moat should show a consistently wider and more stable margin gap. This structural cost audit provides a rigorous, evidence-based way for any retail investor to validate a company's claims of being a low-cost producer. It moves beyond the marketing slogans and forces you to identify the structural reasons for the advantage and find the proof in the financial numbers, a key part of any sophisticated industry analysis. The path of the 99% in industries without a structural cost leader is a brutal and destructive journey known as the race to the bottom. This is what happens when multiple competitors with similar cost structures all decide that the only way to gain market share is to lower their prices. It is a form of mutually assured destruction for profitability. The airline industry is the canonical example of this tragic dynamic. An airline's cost structure is largely fixed. They have massive, unavoidable expenses for planes, fuel, labor, and airport fees. Because their product, a seat on a plane, is largely a commodity, they are forced to compete on price. One airline, in a desperate attempt to fill its planes, announces a fare sale. In order to compete, the other airlines on that route have no choice but to match the lower price. The first airline's temporary advantage is immediately erased, but now the price for everyone has been permanently lowered. The industry's margins are compressed, and no one benefits except the consumer. The shareholders suffer. This race to the bottom is not a sign of a healthy competitive market. It's a sign of a deeply flawed industry structure. In these industries, there is no loyalty and no pricing power. Capital is constantly being poured into the business just to tread water, but the returns on that capital are abysmal. Investors in these industries often get fooled by temporary upswings. An airline might have a profitable year if fuel prices are low or the economy is strong. The investor buys the stock, thinking the company has turned a corner, but as soon as conditions change, the brutal economics of the industry reassert themselves, and the profits evaporate. The race to the bottom is a wealth-destroying vortex. It sucks in capital and produces subpar returns over the long run. For entrepreneurs, starting a business in an industry prone to these dynamics is a recipe for heartache and financial strain. For investors, it is critical to recognize the warning signs. Industries with low barriers to entry, high fixed costs, and undifferentiated products are the natural breeding grounds for the race to the bottom. Avoiding these sectors is a core tenet of good wealth management. It is an acknowledgement that even the best management team cannot save a business that is structurally designed to fail. True financial freedom is found by investing in businesses that are built to win, not those that are forced to participate in a race where the only prize is survival. The financial superiority of a business with a durable cost advantage moat is not just visible in its profit margins. It often extends to a more sophisticated measure of operational efficiency, the cash conversion cycle. This metric measures how long it takes a company to convert its investments in inventory and other resources into cash from sales. For most companies, this cycle is positive. They buy raw materials, pay their suppliers, turn them into a product, sell the product, and then collect the cash from the customer. This process can take 30, 60, or even 90 days. During that time, the company's own money is tied up, financing its operations. However, some of the most dominant low-cost leaders have achieved a kind of financial nirvana, a negative cash conversion cycle. Look at a company like Costco. Because of their immense scale and rapid inventory turnover, they typically sell their products to their customers before they even have to pay their own suppliers for those goods. A customer pays for a television at the checkout with cash or a debit card, and that money is in Costco's bank account immediately. However, Costco's payment terms with the television manufacturer might be 30 or 45 days. This means for a month or more, Costco has the customer's cash and still hasn't paid for the product. In effect, its suppliers are providing a massive, interest-free loan to finance its growth. This is a staggering competitive advantage. While its competitors are borrowing money and paying interest to finance their inventory, Costco is actually getting paid to hold its inventory. This financial flow generates extra cash that can be used to lower prices even further, creating an even stronger virtuous cycle. Furthermore, the concept of scale economies is central to the cost leader's financial statements. As a company like Geico or Costco grows its revenue, many of its costs do not grow in proportion. The cost of its corporate headquarters, its IT systems, and its executive salaries don't double when revenues double. This means that each incremental dollar of revenue is more profitable than the last. This is called operating leverage. As the company scales, its profit margins naturally expand. An investor can see this by tracking operating margins over time. In a business with strong scale economies, you will see margins improve as revenues grow. This combination of a superior cash conversion cycle and the operating leverage from scale economies is the financial engine that makes low-cost leaders into incredible compounding machines capable of generating massive capital gains for their shareholders over the long term. You have just been given the master key to the market's most exclusive club. You've been shown the fundamental distinction that separates the businesses that struggle from the franchises that soar. You now possess the mental framework to identify the four great economic moats: the intangible assets, the switching costs, the network effects, and the cost advantages that protect the untouchable companies. This is not just theory. It is a practical arsenal of tools for stock analysis, for executive decision-making, for building a portfolio designed to beat the market and achieve financial freedom. You have absorbed a core pillar of the Warren Buffett strategy, a way of seeing the business world with a clarity that eludes 99% of other participants. But understanding what makes a company great is only the first half of the equation. A great franchise is a wonderful thing to find, but its power is only unlocked for you as an investor if you buy it at a sensible price. The true genius of the Buffett and Munger approach lies in the intricate connection between identifying quality and assessing value. Knowing tree to buy is a different skill from knowing tree when to buy and at what price. That requires an entirely different set of mental models. Models for calculating intrinsic value, for understanding the psychology of market prices, and for developing the patience to wait for the perfect pitch. The journey from identifying a great company to buying it at a great price is the bridge between analysis and action. The video on your screen right now is the next piece of that map. It is the link that connects the fortress to the treasury. It is designed to take the knowledge you have just acquired and weaponize it, turning it into a disciplined process for capital allocation. You have proven that you are not a casual observer. You are a serious student of this craft. You have invested your time to ascend to this level of understanding. Do not stop now. The most crucial part of the journey lies just ahead. Complete your mental arsenal. Fulfill the promise of this knowledge. Click the video and continue your ascent.